between IRAs, 401ks, Roth IRAs, and just what each account really is. But before we get started, let's do this quick disclaimer. West IRA does not offer investment, tax, financial, or legal advice to clients. We do not promote, endorse, or offer any investments. Individuals who believe they need advice should consult with the appropriate professionals licensed in that area. If you are feeling a little bit confused on whether you should contribute to an IRA, a 401k, or maybe even a Roth IRA, you are not alone. Each one has unique tax advantages, contribution limits, different perks that can impact your retirement savings. In this video, we are going to break down the key differences between a traditional IRA, Roth IRA, and a 401k so that you can choose the right mix for your goals and maximize your retirement nest egg. Make sure you stay to the end because we will be sharing a bonus tip on how to invest in alternative assets through self-directed accounts for more control over your future. All right, the different types of accounts and why this matters. So retirement planning can get extremely complicated. If you are feeling overwhelmed, it's okay, it's normal. But learning about the different types of retirement accounts will help you when you get to the planning so that you can really build a strategy that works best for you. And number one is knowing the different type of accounts and what the contribution amounts are for each of these accounts, and then what you can invest in. Choosing the right account will determine if you pay now on taxes or you pay later with taxes. Do you grow your wealth with a tax deferred account or grow it tax free? What are the advantages that your employers have or the perks that your employers have right now? And just making sure you overall just stay on track for your financial freedom now, later, and in the future. So getting started with the traditional IRA. Who can contribute? Anybody with earned income can contribute to a traditional IRA. Earned income means W-2 or 1099 income. The IRS sets a limit every year on what the amount you can contribute into your traditional IRA is. In 2025, at the time of this recording, it's $7,000 if you're under the age of 50, and if you're over the age of 50, it's $8,000. You will have required minimum distributions starting at age 73 with a traditional IRA, and you must take those distributions or else you will face penalties. And when you have an account at Mountain West IRA, when it comes to that time, we do notify you to let you know it is time to take a distribution. With the traditional IRAs, the tax treatment that you would have right now is that you may be able to deduct your contributions from your current taxable income. So this is something your CPA will help you with when it comes to tax time. Your money grows tax deferred, meaning that you'll pay taxes later. And any withdrawals in retirement are going to be taxed as ordinary income, which for people who are investors or have a variety of different incomes, sometimes that ordinary income is quite a bit of a lower tax rate than maybe an investment income or a self-employed income. You also have flexibility where you can invest in whatever it is that you'd like to invest in with a self-directed IRA. This includes real estate, promissory notes, private loans, private placements, cryptocurrency, precious metals, and really just so much more. We have clients that invest in everything. So bring it to us if you have an idea, if you have knowledge in how to do that investment, or you have knowledge in that industry. You never know. We bring it to us and we can see if we can help you get that investment started inside of your retirement account. Now you have a Roth IRAs. With a Roth IRA, anybody who contributes to a Roth IRA does have to have earned income. There are phase out limits. However, we're going to skip over those because I feel like it kind of gets confusing. And what I'm going to tell you is if you are above the taxable income of those phase out limits, it's okay. You just cannot contribute directly to a Roth. You can do a backdoor Roth conversion, which just means that you contribute to a traditional IRA and then the next day we convert it into a Roth IRA. A little bit more paperwork, but you still get to invest in the Roth, which is what the goal is, right? So paperwork's not hard, I promise, when it comes to setting up your retirement account. Now with the Roth IRA, the contribution limit is the same as the traditional IRA, which is $7,000 under the age of 50, $8,000 if you are above the age of 50 for 2025. Required minimum distributions. You do not have required minimum distributions or RMDs because you've already paid your taxes. So with a Roth IRA, we are paying our taxes in current year. So on your tax return, it will look like you made that $7,000 that you put into your Roth IRA. So it'll show your taxable income, including the $7,000. But later, 20, 30 years, 40 years down the line, when you go to take funds out of your retirement account, you do not get taxed, and you're not required to take funds out of that retirement account if you don't want to. You can withdraw your contributions anytime when it comes to the Roth IRA because you've already paid taxes on them. So the IRS doesn't really care if you take those funds out. However, if you have gains or your investments have made money inside of your Roth IRA, those funds are or have the potential to be taxed if you do not leave them in there until you hit retirement age. So the Roth IRA tax treatment, you have your contributions are made with after tax dollars, so no deduction now, but later you don't get taxed. And then your money grows tax-free. So any investment that you put into your retirement account will grow tax-free. And then you have qualified withdrawals in retirement that are also tax-free. So we love Roth IRAs. Roth IRAs are for a very specific type of investor who understands that you're gonna have to pay current taxes now. You're not getting that benefit of the write-off because you're paying taxes now, which I like to think about, like, are we going to see taxes ever lower in the next 50 years? Like, what could taxes actually be? So even though you may retire off the same amount of income that you're making currently, but taxes are higher, it may be best to look at that Roth IRA if that's what you believe is going to happen within the US. So making sure your strategy matches the economics plan is a really big deal when it comes to retirement accounts. Mountain West IRA is not able to give the client's opinion or give advice. So keep in mind, this is a strategy you will work with your CPA or financial advisor, and then you'll just come to Mountain West letting us know, hey, I want a traditional IRA, or hey, I want a Roth IRA. And we will let you know what type of fund, how you're going to fund it. You'll let us know, and we'll make sure you have the right paperwork. Now let's talk about the 401k. The 401k is an employer plan. Most employers have a 401k plan. If they do offer a 401k and you're eligible, then and if you're self-employed, so you own your own company, you can open up a solo 401k here at Mountain West IRA. We can help you with that. But most 401ks, they are employer plans that your company actually opens for you. Now you have your contribution limits for 2025. So the employee can contribute up to $23,500 if under the age of 50. And if over the age of 50, you get to have the opportunity to contribute up to $31,000. And then if you are over the age of 60, you actually have the opportunity to contribute more, $34,750. I know it's a weird number. I don't know why the IRS does that. And then you have your employer match. So there's employees and then there's employers. For a 401k, the company that you work for, they would choose if they do an employer match. If they do a match, it's free money basically by putting money in your retirement account. Great idea. Now for the solo K people who are self-employed and maybe you have your solo K or individual K plan here at Mountain West, the employer also gets the opportunity to match. So as the employer of my company, the employer would then choose, I want to put a percentage of adjusted gross income into my 401k plan, and the business, so the employer, would get that write-off. So it would be a traditional portion of your 401k plan. Now for the solo K, you can have traditional and Roth in one umbrella of a 401k plan, but I'm going off on a tangent with that. But just keep in mind there's an employer and the employee portion. We do have videos talking all about solo K plans. If you are self-employed, then you'll definitely want to go check that out and give us a call. Back to 401ks. Required minimum distributions, they are a thing. You do have to take a required minimum distribution starting at age 73. However, with the Roth portions, you do not have a required minimum distribution because you already paid your taxes. And then investment options, same thing. With a solo K plan, especially if it's here at Mountain West, you have the opportunity to invest in anything that's allowable inside your IRA. And with a solo K plan, you can actually open up a public stock trading platform account here at Mountain West. It's not held through us, but it is through your K plan, so you do have the opportunity for that. Now, for people with 401ks, most of the time, unfortunately, you have to leave the company, retire before that 401k can actually get moved to an IRA that you can self-direct. However, there are every once in a while companies that do allow for some sort of movement of funds. You just need to reach out to your HR department to ask that. But most of the times, I would say you have to leave the company before they'll allow you to move those funds. Now, the tax treatment with a traditional 401k, your contributions get reduced taxable income. So you get that you get that tax savings now, and your investments grow tax deferred, and your withdrawals are taxed in retirement. Now, if you have the opportunity in your 401k or company to have a Roth option, or you have a solo K plan and you have a Roth option inside of that solo K plan here at Mountain West, then at that point, just like a Roth IRA, your contributions are taxed current year. However, when you go to withdraw later in life and all those gains, those grow tax-free inside of your account. Now, which IRA or which account type is best for you? So the traditional IRA is great for you if you want that tax break now, or your workplace does not have a retirement plan. The Roth IRA is great if you expect to be in a higher tax bracket later, or if you want to grow tax-free for retirement. And then the 401k, also the solo K plan, is best if your employer does a match and you want to put more money away. Of course, we never want you to leave free money on the table if your employer does a match, but it's also perfect if you are self-employed and you want those higher contribution limits. The plan does cost more on the setup and the fees. However, you can put quite a bit more money away than that $7,000, $8,000 that the IRAs can do. Many people who save can do a mix of all three types of accounts and other accounts that we don't even offer here at Mountain West IRA. But if you want that extra flexibility of a self-directed, we just want to make sure that you have the right account that fits. Now that you know the main differences between a traditional IRA, Roth IRA, and the 401k or the solo K plan, you have the tools that you need to make a strategy with your financial advisor or your CPA and start expanding your investment options. You can give us a call at 866-377-3311 or book a free, no cost, no obligation consultation today by clicking the link in our bio. Make sure to like, subscribe, and share with a friend. Thanks for watching.